I think hard assets are going to scream higher, and especially in 2026. So that's not really a short-term comment. People are just getting out of the dollar, Julia. People are looking for a place to hide outside the erstwhile world's reserve currency. And then something broke a couple of years ago, and it continues to break. I don't know if it's because we have sanctions and confiscations, because we have trade wars. Foreign countries no longer want to recycle their trade surplus into dollars. They're selling their dollars and they're buying gold and they're buying platinum. And that's a good alternative.
BRICS member China is accelerating its move away from U.S. dollar-denominated assets, selling nearly $8.2 billion worth of treasuries in April 2025, according to the latest data from the US Treasury Department. The sell-off came shortly after President Trump imposed sweeping tariffs on several nations during early April, coinciding with Liberation Day. In what appears to be a strategic counter-response, China is not only reducing its exposure to American financial instruments, but also increasing its gold reserves, thereby reinforcing its position within the BRICS alliance. MichaelPento, president of Pento Portfolio Strategies, notes that the old model, where creditor nations recycled trade surpluses into US Treasuries, is rapidly collapsing. Sanctions and trade tensions have changed the calculus. Nations are now pivoting to hard assets like gold and platinum, forms of wealth they can hold outside US influence. This global shift is already reflected in reserve trends. A recent report from the European Central Bank confirmed that gold has overtaken the euro to become the second largest global reserve asset. Central banks, especially in emerging markets, have been aggressively increasing their gold holdings in response to geopolitical instability, persistent inflation, and growing distrust in the reliability of dominant fiat currencies, a sentiment amplified after Russia's 2022 invasion of Ukraine. Pento adds that 2026 could mark a significant turning point. Inflation, while no longer accelerating at the peak rates seen in recent years, remains uncomfortably high and continues to erode real incomes, particularly for the middle and lower classes. The damage has already been done, he says. The setup for a sharp rally in hard assets like gold is in place. U.S. inflation inched higher in May, offering little evidence of broader tariff-related impacts so far. Still, the Federal Reserve expects those effects to become more visible as the year progresses. Amid rising uncertainty and eroding trust in traditional assets, gold's role as a strategic reserve and inflation hedge appears more relevant than ever. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I'm old enough to remember when platinum was much more expensive than gold. Well, there was, people, I remember when everybody was upgrading their ring. Yeah, because you had to upgrade your ring because platinum was more expensive than gold. Well, platinum used to be more expensive than gold. That is not the case anymore. Platinum is far below where gold is. Gold, 3,300, platinum, I think it's $1,200 an ounce, somewhere around that. Anyway, but platinum is more rare than gold. It's a more noble metal. It lasts forever, just like gold does. And I noticed, I think about a month or two ago, a technical breakout in platinum. And just because the gold platinum ratio just got way out of whack. So I didn't sell my gold. I still own gold, but I thought platinum would be a wonderful play. Given that, people are just getting out of the dollar, Julia. People are looking for a place to hide outside the erstwhile world's reserve currency. You think about what our creditor nations have done in the past. So they get dollars for manufacturing goods and selling them to us. They get those dollars and they just recycle them in our bond market. It was great. They had a strong currency, had a nice return on the treasuries. And then something broke a couple of years ago, and it continues to break. I don't know if it's because we have sanctions and confiscations, because we have trade wars. Foreign countries no longer want to recycle their trade surplus into dollars. They're selling their dollars and they're buying gold and they're buying platinum. And that's a good alternative because, if I take my dollars and sell them and buy platinum and I store the platinum in my own nation, I don't care what any U.S. president says about imposing a sanction on my country because I own my wealth. I own my own wealth. They cannot confiscate my wealth. I own my own wealth. So that's one of the reasons why I think platinum is another alternative to the dollar. I think hard assets are going to scream higher, and especially in 2026. So that's not really a short-term comment. Do you think about what's going to happen in May of 2026? So we already have a condition where the Federal Reserve has a 2% target for inflation, and they've missed that target to the upside for 4 years. They're going to miss it to the north for 6 years. So they're still not going to be at 2% in May of 2026 when Mr. Powell's fired. They'll probably still be, unless we have a devastating recession, which is a possibility. That's the only way it's going down. Inflation is going lower. It's still going to be above 2%. And please keep this in mind, Julia. Inflation has eviscerated the bottom 4 quintiles of consumers. So it's the level of prices that is so onerous and so damaging. So it's not that prices are coming down. People say, oh, inflation is down. It's the rate of change. So it's a second derivative of inflation. So it's not rising at 9, it's rising at 3. Okay, well, congratulations. But prices are still high. They've already wiped out, the level of prices has wiped out the middle class. And they're still rising above the rate that the Fed wants them to rise. And then you come to May of 2026, and we're going to have an obsequious sycophant take the place of Jerome Powell and slash interest rates back into negative territory in real terms, profoundly negative. So there's going to be a mass exit, and this is going to take place no matter what's happening in the economy. No matter what's happening, President Trump wants interest rates down by 2 full percentage points now. So you can argue if that's the right thing to do or not, but it's not going to be helpful to inflation, the rate of change of inflation. So I think there's going to be a mad dash out of the dollar, especially in 2026. And I want to own platinum. I want to own gold. I might even want to purchase silver before that time comes. I think the Eccles building should be bulldozed. And I'm not advocating any kind of violence. I think the Federal Reserve institution should be defunct, go out of business. I'll be very clear about that. We do not need a cabal of pretend faux omniscience to set the cost of money. That is absolutely ridiculous. It should be the supply of savings versus demand for money should set the cost of money. And the base money supply, which is what the Fed controls, all right, physical coins and currency and Fed credit, that should be set by the increase in the mine supply of gold, which is never more than 2%. Which happens to be commensurate with labor force growth and productivity growth. See how beautiful it is? And then if a bank goes out of its way goes crazy with the fractional reserve system and gets over their skis, that bank should be allowed to fail. So we have creative destruction. If you have a self-fettering mechanism then where you won't have these asset bubbles in place. You won't have a condition where the first-time home buyer has been completely priced out of the home buying arena. Home prices are unaffordable. That's disgusting. And you hear Jerome Powell, everything we do is in the interest of the American consumer. Blah, blah, blah. No, it was you were buying mortgage-backed securities, Jerome, in the spring of 2022 when COVID was a distant memory. Why were you blowing up the housing bubble 20% year after year in price? For what reason? First of all, 1913, when the Federal Reserve was enacted, they only had the authority to, at a discount, take in treasuries owned by a bank, a member bank, right? That was it. It was never to buy corporate debt or junk bonds or mortgage-backed securities. So it's the Federal Reserve's fault for the inflation that has been inflicted on the American people. Make no mistake about it. And they know that. Everybody should know.
MichaelPento warns that in the next recession, with the United States already running a $2 trillion deficit, the shortfall could balloon to between $4 and $6 trillion. Such a spike would likely be met with Federal Reserve stimulus, most likely in the form of quantitative easing, funded through massive Treasury auctions. That, in turn, would rapidly expand the money supply and risk igniting severe inflation. The scale of borrowing is already concerning. According to the latest monthly budget review from the Congressional Budget Office, the U.S. borrowed $838 billion in just the first 4 months of fiscal year 2025, including $127 billion in January alone. That's an average of $7 billion per day, pointing to an alarming trajectory that shows little sign of slowing. Interest payments on the national debt are now projected to reach $1 trillion annually. If current trends hold, the national debt is expected to surpass its World War II-era record within the next 4 years. With discussions underway in Washington on costly initiatives, from tax extensions to increased defense spending, there is rising pressure to rein in fiscal excess. Policymakers are being urged to commit to no new debt and to implement meaningful deficit reduction measures in any new legislation. Let's get back to the interview.
If you put up a chart, and Federal Reserve actually publishes this data, there's a chart of the real Fed funds rate. So it's the Fed funds rate minus CPI. Since 2002, it's been negative all the way from 2002 to 2022, it's been negative for most of that time, like 85, 90% of the time. That is a very unusual phenomenon where there was no real cost of money. It was free. You would get paid to borrow. As a matter of fact, it went all the way to minus 8% in 2020. So you could just borrow money and buy anything, and you would make money because those prices were rising at double digits, and you were borrowing it for almost 1%, 1 or 2%. Now that should never be the case. That's why we have this. And we had a case of helicopter money in 2020. That's the reason why the inflation didn't stay on Wall Street. After the 2008 global financial crisis, a lot of the Fed credit went to bail out banks. So banks had bad assets, mortgage-backed securities. The bank received credit from the Federal Reserve. Federal Reserve took on these bad assets. The banks had credit, so they were solvent. They could keep their doors open. But the money supply never really boomed because the money wasn't lent out into the larger aggregate. Wasn't really going to making massive loans because the public had a lot of debt. The next time we have a recession, and I think I said it's every 6.4 years is the average. We're starting out, Julia, with a $2 trillion deficit. The deficit's going to go between, my estimates is the annual deficit 1 year between $4 and $6 trillion. So the next time the Fed tries to bail out the economy by returning to ZIRP and QE and whatever, that credit that goes into the banking system is going to have to be used they have no choice. The primary dealers have to participate in auctions. So that money will be via the primary dealers as a conduit will go directly into treasury auctions, which is going to boom the money supply. Imagine having a $6 trillion a year deficit. $6 trillion. The last two recessions, the deficit went up by 300% in the last two recessions. If it happens again, we're going to have a $6 trillion deficit. So it happens automatically. The automatic stabilizers kick in. So the revenue dries up. Unemployment rate skyrockets. You have unemployment insurance kicks in. These are called automatic stabilizers. They don't have to be voted on by anything. And then, of course, if you do get the unholy union of Treasury and the Fed together, Donald Trump did say that he could take on the job. He doesn't know why he needs the Federal Reserve. He should just set the interest rates. So, I mean, if you get a union between Bessent and whoever, and they have another form of helicopter money, you can get, once again, trillions and trillions of dollars. This is not my imagination. It already happened during COVID, right? The Fed monetized $4.5 or $5 trillion of the $6 trillion in spending and mortgage forbearances and all that other stuff that we did post-COVID. And then you're going to have inflation take off, not from a very low number, from a high number, and then keep on going, because what's the market going to think about our ability to ever get inflation under control or ever get our budget under control? I call it a death spiral, so people say, the consumer's healthy and they don't have any debt and corporations have cash, blah, blah, blah. When it's a corporate debt, business debt as a percentage of GDP is at very close to an all-time record high. Household debt is down to around 70%, 75%, I think, 75, 76% of GDP. But it used to be like 50% of GDP, going back decades ago. So it's not like the individuals don't have any debt, but it's not only the debt. Remember, I told you they're already extremely burdened by inflation. So they don't have the cash flow to handle the debt that they have. And then you say, well, what's the problem, Mr. Pento? It's government debt. Everybody knows the government is in deep. Everybody knows. I hate when people say that, because who cares what everybody knows? The fact is the government has a massive problem with debt and deficits, and almost everybody acknowledges that's the case, Republican and Democrat. So if you have $6 trillion annual deficit, and which is our debt is already 720%, 740%?
I don't know the percent, but we crossed 37 in the U.S. national debt, 37 trillion.
Yeah, it's 37 trillion. But our debt as a percentage of revenue, which is what I look at. If you look, debt to GDP is 124%. But I don't care. We can't tax GDP. Try to raise taxes, which can't pass Congress anyway. But you can't tax GDP. Go to 100%, you get zero GDP. So I mean, listen. It's debt as a percentage of revenue, which is about 740%. So our debt is 740% of our revenue. That is incredible to me. So what happens here, Julia, is if we have an insolvent nation, and then the interest rates spike out of control. The Fed's printing money like mad to try to get them down, but they still rise regardless. And he says, is that really a problem? Yeah, it's a big problem, because I think about what are the things that are priced towards the 10-year note? Well, first of all, we borrow a lot of money, right? Our interest on the debt is well over $1 trillion. So I think it's $1.2 trillion this year. That's the estimate. So that's a big problem. But then mortgages, right, are priced. If we have right now, mortgages in this country are around 7%. What happens if they go to, double digits? Is that going to help the housing market, which is oriented tonight? You know what else is priced off of the benchmark treasury? Corporate debt, business debt, private credit, auto loans, student loans debt is all priced off the benchmark treasury. So that is going to be the catalyst for the next debacle. And when we have a crisis like that, where the Fed's actions don't ameliorate the problem, they actually exacerbate the problem, because creating inflation doesn't usually send people scurrying into the long end of the bond market, correct? You'll have the private sector shorting bonds like mad, which I will be doing for me and my clients. That's the real problem, because where's the help going to come from?
Africa is making a decisive shift in its economic strategy by launching the Pan-African Payments and Settlement System, a homegrown initiative designed to reduce reliance on the US dollar for intracontinental trade. This bold move places Africa firmly on the path of de-dollarization, echoing the steps taken by BRICS nations that promote the use of local currencies in global transactions. PAPSIS is engineered to streamline cross-border payments by allowing trade settlements in local African currencies, thereby saving countries substantial sums previously lost to currency conversion. Estimates indicate that settling $200 million worth of trade in US dollars could incur foreign exchange costs of 10% to 30%. In contrast, using PAPSS brings that burden down to just 1%. A quiet transformation is reshaping the global financial landscape, one marked by rising distrust in legacy systems and a powerful pivot toward tangible stores of value. As emerging economies shed their dependence on Western monetary tools and develop independent payment networks, the foundation of the post-war financial order appears increasingly unstable. Hard assets are no longer just crisis hedges. They're becoming the preferred instruments for nations navigating a multipolar world. Could this accelerating movement away from the dollar signal not just a monetary adjustment, but a structural reset of global power dynamics? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.